Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian equities get a lift from Wall Street, where technology stocks continue their charge, driving the S&P 500 to a fresh all-time high. It is the 54th time the U.S. benchmark has set a record this year. The U.S. unveils tougher curbs on China's access to chips, and Donald Trump is not even president yet. Chinese ETFs seeing record outflows on his tariff threats, while the yuan hit its lowest in a year. Indian stock valuations are still pricey even after a record sell-off in October, but that's not stopping investors betting on a central bank rate cut after the GDP shock. And on Insight today, we're all about finding value with the world's most renowned academic on the subject, NYU School of Business professor Aswath Damodaran, known as the Dean of Valuation, joins us across the next hour. Well, the S&P 500 had posted its 54th record close of the year in a rally led by tech mega caps. We're talking Microsoft, Meta, and Apple. That helped the index extend last month's advance, which was its best performance in a year. Traders betting that Donald Trump's agenda of tax cuts and deregulation will further boost an economy that's already growing solidly. Avril Hong, on top of market developments, there is no stopping the S&P 500, Avril.
Yeah, it looks like this run has legs. I mean, you look at how it's the 54th record this year on the US benchmark. Overnight, it was led by gains in the world's largest tech companies. How much further room to run? If you're talking to the likes of JP Morgan's trading desk or Goldman Sachs, they think 6,200, 6,300 before the year is up, very possible. So that's another 3-4%. And traders seem to think we're going to see a Santa Claus rally. You look at the environment, that seems to back that case. I mean, you alluded to this, the solidly growing US economy. More recently, we saw Black Friday, Cyber Weekend sales. Those were strong. Overnight, we also got dovish Fed speak, which I'll get to in a bit, but flip the board and take a look at this chart because I wanted to put things into perspective. How much heavy lifting the Mag 7s are doing. If we can take a look at this next page, and it'll show you how overnight we did see them advancing about 1.9%. This is to the highest level of the Mag 7s since records began in 2015. But if you look at the equal weight S&P 500, that is forward 12 months PE versus the market cap weighted version, the premium looks much more muted. So it gives you a sense of what else to keep in mind. For the board, as I say, we got dovish Fed speak from a hawk, no less. And this was Christopher Waller. He says he's leaning towards a December cut in the absence of any data surprises. But the likes of Williams, Bostic, they sounded a lot more nuanced in their comments. And, you know, they didn't outright say whether they're backing a December trim. So markets not fully pricing in a 25 basis point move just yet. We also have crucial employment numbers due on Friday out of the US House.
All right, we await that data. Avril Hong, thank you. So the S&P keeps notching new record highs, but do the fundamentals really add up for the companies driving the rally, particularly the so-called Mag 7 global tech giants? Our guest here in the studio has his doubts. Aswath Damodaran is professor of finance at New York University Stern School of Business, sometimes dubbed the Dean of Valuation. Good to have you with us, and
Thanks
welcome to the city. So this is a market price for perfection.
Yeah, and I think it's been priced for perfection all year. And we keep our fingers crossed saying maybe there will be no correction. But there's going to be a cleaning up. Whether you call it a correction, there has to be a cleaning up. You cannot have back-to-back years like 2023 and 2024 and not expect something to be fixed leading into 2025. That doesn't mean you sell equities and head for the hills. But if you look at the earnings and the cash flows, the market is not just pricing in those earnings, but it's also pricing in an expectation that there will be no crises. And if you think about everything that's happened since 2008, the one thing we know almost as a constant, every 2 or 3 years, something happens that's big and global. And I think you need to build that in, and the fact that the market is not building in is a little troubling, because you could say, what happens when you have that crisis?
As you said, it is troubling. When you take a look at VIX, it's at 14. And that against a backdrop of uncertainties, including Trump's tariffs, which could weigh on sentiment, which could weigh on growth. How are you looking at how markets are assessing the risks out there?
Yeah. If you think about markets, there are two games that go on in markets. One is what I call the pricing game. It's driven by mood and momentum, and there really fundamentals don't even matter there. And there's the investing game. You talk about fundamentals. The balance shifts over period. This is a pricing market. The reason I think fundamentals don't even come into play is when mood and momentum is this strong, they steamroll everything. So I think at the moment we have a pricing market where traders are driving the game. And traders really don't care. I mean, they might pay lip service to earnings and cash flows, but the truth is, they really don't care. It's all about mood and momentum.
Mood and momentum, and you see that for the MEG 7. No stopping the MEG 7. And you say, find that opportunity to own a MEG 7 stock.
Yeah, and I think in a sense, I have never seen a group of companies carry a market for as long a period as the MEG 7, or the FANGAM, as I used to call them in the last decade, carried this market. 15% of the gain in all U.S. equities across 7,000 stocks has come from 6 or 7 companies. The numbers are mind-boggling. You know, we're talking trillions of dollars in market cap added every year. The MEG 7 companies alone, if they were a market, would be the second largest equity market in the world after the U.S. equity market. It's that big a chunk. But when you have mood and momentum, it's often built on some reality. The reality here is these companies are special companies. They've been able to scale up not just revenues and growth, but some of them are insanely profitable. Nvidia has gross margins of 75%. I mean, that's outlandish if you think about it. You know, the operating margins are 60%. These companies, at least most of them, are cash machines. And so if you're thinking as a value investor, I've never seen cash machines as lucrative as these companies are. And I don't see the cash machines slowing down. I think the pricing might be getting out of control, but they are pricing in companies that are deservedly among the best companies in the world.
But you talk about Nvidia, we're talking about PE of 54. It's already surged 180% year to date. I mean, how much more upside is there? I mean, Isn't this a company that's already overpriced, overvalued?
And I think when you talk about Nvidia, you've got to bring AI into the picture. The reality is that AI for the last 3 years has been this buzzword that's driven stocks. Nvidia is the one company that has actually made money on AI. Everybody else talks the AI game. But this is the company that has made money on AI because right now the money being made in AI is in building architecture, chips, cloud storage. And Nvidia is 80% of the AI chip market. So it starts with that position of strength. Embedded in Nvidia's pricing is the expectation the AI market is going to be huge. My estimate is about 3 to 4 trillion is the implicit estimate you would need to justify Nvidia's pricing. And the test for Nvidia is going to be, the architecture is going to get built, but ultimately that architecture is a cost to some company. The 4 big tech companies, which account for 50% of AI chip sales, they're buying these chips, building the architecture on the expectation that they can create products and services that they can turn out. And right now I can't think of a single company that is actually making money on AI products and services. There's promise, there's potential, and we don't know whether we can monetize these products and services enough to cover the cost of the architecture. So that to me is the big test for Nvidia, is not whether people will buy the chips, but whether they can turn out products and services that people are willing to pay for.
If you're playing the theme of AI, can you get exposure to AI in companies that are less elevated when it comes to valuations?
I think you can, and I think you'd have to decide what kinds of companies will benefit the most from AI. And I can see you've seen the disruption happen for some companies from AI. Chegg, the homework-based, has dropped in value dramatically because instead of hiring human tutors, you can now have an AI tutor, and that's going to replace the basic business model for the company. There will be companies that will start churning out products and services, getting in on the ground floor in companies that actually have the capacity to use these products and services to grow the market is an alternative. But right now, the one sure thing now is the architecture companies, the companies that are building the AI architecture.
We have to talk about Tesla. It's also surged. In fact, Tesla getting a boost from Elon Musk's exposure to President-elect Trump. You've said before that you do not like playing stocks which are connected to politics. He is obviously linked to the political scene in the US. How do you play Tesla, or don't you play Tesla now?
I mean, I started valuing Tesla in 2013. When I first valued Tesla, it was a luxury automobile company. It became a mass market automobile company, energy. I've never ever valued a company where the story keeps shifting on a year-to-year basis. Right now, the story is shifting again to becoming a politically connected electric car company. And you know what? It's a company that because it's also a company connected to a personality. You cannot talk about Tesla without talking about Elon Musk. They're connected at the hip. There's always a danger when you connect to a personality, which is, you're connecting to a human being with all of the mix of good and bad stuff that comes with it. So when Tesla shareholders complain about Elon's other activities, remember, you bought the package. You can't take advantage of the vision that he brings to the company and not take into account the other stuff. And right now, there's a very real danger that the political connections and the stuff that he's doing might get in the way of Tesla. Right now, it looks like they will benefit, but who knows? How will it affect sales if people decide that they will not buy Teslas because they don't like the politics that comes with it? So there's a very real danger as well for Tesla of being politically connected. It's not an unmixed blessing. I mean, we think about the regulation, the things that will work in their favor, but there are other things that will work against them. We'll see what the net effect is. It'll take a few months, maybe a couple of years to play out. But 2 years from now, we're talking, we'll see where Tesla is because we'll see the net effect of politics.
This is a company that's valued at more than $1 trillion. Yeah. Is it fairly valued?
I own Tesla, so I have that bias kicking.
You own all the Mag 7?
I own all of the Mag 7, but I bought Tesla earlier this year at $170. And that's something to remember about these companies. When you look at these companies, your first reaction is, they're so richly priced, I will never be able to own these companies. And my reaction is, with every one of these companies, at least once, and more often 2 or 3 times in the last decade, they've been cheap enough to be undervalued. So if you don't own any of the Mag 7, rather than give up on them, I would say wait. There will be moments of correction here, maybe in 3 months, maybe in 6 months. And I would suggest that when that happens, you find a way to add at least 1, maybe 2 or 3 of these companies, because there's so much part of what drives the economy and the market. Now, I remember in 2020 when at that time, the FANG-AM stocks were pushing the market ahead, and people said, how can these 6 companies account for so much of the increase in value? And I ran an experiment that I talked about in my blog. I said, look, I woke up in the morning, and through the entire day, I kept track of which tech company's platform I was on at that point in the day. And outside of about 15 minutes when I went to the restroom, for the rest of the day, I was in one or more of these companies' platforms through the rest of the day. I was watching Netflix or I was checking my smartphone. These companies, essentially, our lives revolve around these companies. So I don't think we should be surprised that they end up dominating markets as well, because if you're so dependent on these companies for the way you live, it's going to show up in the market cap.
Prof, I'm just wondering, I mean, we had a colleague who said that the Mag 7 is actually derailing the fair value model. It is so hard to be talking about fair value because the Mag 7 are actually driving up a lot of these prices. So how do you, value stocks now?
I think when he talks about the fair value model, I'm not familiar with which version of the fair value model he's talking about. Most fair value models are mechanistic. They draw on history and they build into a mechanical model. With the Mag 7, you cannot have a mechanical, you have to have a dynamic valuation model. You've got to factor in growth. You have to accept uncertainty. You've got to build things into your model that you generally don't do in a mechanical model. As I said, I bought the Mag 7 because they were undervalued. I didn't buy them for the momentum and the mood. I'm not a trader, I'm an investor. So I disagree. I think you can't use rigid discounted cash flow models or intrinsic value models. You can't use rigid rules on PE ratios. But if you're flexible and dynamic in the way you bring in fundamentals into your valuation model, I think you can find these companies undervalued. Right now, all 7 are, I think, fairly or overvalued. But there will be times, and I can almost guarantee you, over the next year, where at least 1, maybe 2 or 3 of them will become undervalued again.
You talked about how it's all driven by mood, momentum, and that mood and momentum driven by Trump right now. How will Trump shape, influence valuations in the market?
You know, I'm not a political analyst, but Donald Trump is an agent of chaos. Right? I mean, he brings in uncertainty. It's almost like, it brings a swirl of uncertainty with him. And I think I think markets in a sense have seen it over the last 4 years. They're not as terrified by it as, I mean, if you'd never seen what Trump did, and this was the first time he did it, the fact that he threatened a 25% tariff on your 2 biggest trading partners would have probably caused markets to drop by 15%. You notice that they just blew through that. In a sense, they're not quite sure how much of this is deal-making threats, how much is real. But I have a feeling that markets have adapted to that uncertainty. They're learning to live with the chaos, and we'll see how much chaos they can take. I think the real question is if that chaos shows up in real economic effects. Then I think you might see markets worry, but you're going to see threats and talk, and the markets are just going to ignore it and keep going back. In fact, one of the most interesting things about last year during an election year where there was so much uncertainty is how markets seem impervious to all of that talk and how they just kept going up. So maybe markets have learned to adapt to that chaos and uncertainty that comes with the Trump presidency. But we're going to find out over the next 4 years how much they can take.
We started the show saying that the S&P notch is 54th record high. Where do you see the S&P ending the year and 2025? We had the likes of Goldman saying 7,000 is a level they're looking at the end of 2025.
No, I'll be quite honest. I think investment banks should stop making forecasts because, in a sense, they just chase the market around. Their target will keep moving. The market goes to 6,500 in the next 6 months. You know what the target is going to be? 6,700. So it's kind of so I know they have to put out this number.
Okay, what's your own projection?
Now, my projection is, I'm not a market timer. When you're not a market timer, your projection for the market is you're going to take the market and you're going to earn an expected return. Based on how stocks are priced now, it's about 8 to 8.5%. Stocks are priced to 8. So if you wanted me to give you a number, it's about 8% higher than 2,600. That's still a decent return. But if you're expecting another 26% year, you're probably asking for the moon. I don't think it's going to happen. So if you ask me to pin me down in a profession, it's about 8% higher than 26,000. Let's see how it works out. No, but I think that with market timing, you just have to roll with the punches.
8% ain't too shabby. Prof, hang tight. No. Aswath Damodaran, professor of finance at NYU Stern Business School, will be with us still. Coming up, we'll get more insights on Donald Trump's White House return. Penta Group partner Bryan DeAngelis will joining us to discuss the realities of his planned trade war and its potential impact on Asia's economy. Keep it here with us. This is Bloomberg. Welcome back. It is that perennial India versus China debate, taking a look at where we are in terms of discount. China trading at a 40% discount to India. Of course, we've been talking about how money's been flowing out of India into China, given lower valuations and optimism perhaps that stimulus may just boost the economy. Taking a look where we are, that full screen that you see on your screen right now, China discount or India premium. Of course, we're having this conversation on the back of the Chinese yuan trading at the lowest level in a year on the back of new tariffs, restrictions rather, that the U.S. is imposing on China when it comes to chips. Professor Aswath Damodaran is still with us. Yes, we've been talking about this China discount or India premium. How do you weigh on this?
No, I think it's fascinating. If you take this century, for the first 20 years of the century, China alone accounted for half of the real growth in the global economy. It carried the global economy. And you can do it only so far. And one of the things that happens when you carry the global economy is you get larger as an economy. China is now the second largest economy in the world. The days of 10% real growth are done, no matter how much you try to dress it up, because you're going to converge on the growth. So I think part of this is a scaling up effect. China is now a larger, slower growth economy. And the world is looking to who can carry us for the next 10 or 20 years. And unfortunately, when you need 1 billion plus people, there's only one other candidate. And that's the basis of the India story. You start with 1 billion people plus. That's the first piece of the story. You have enough of a people coming through the pyramid of the education system that you have engineers and scientists and mathematicians being churned out in enough numbers to keep the economy going. And you have a number added to your middle class each year that's the size of a mid-sized European country. You have the basis for the India story. So I think the India story has legs because it is the only country capable of doing what China did for the last 20 years, perhaps for the next decade.
But India's growth is slowing. We saw how the latest quarter came in at 5% versus estimates of 7%. There are earnings issues, and maybe it's not so rosy anymore.
And there have always been seams in the India story. I mean, there are 3 major seams in the India story, no matter how strong you make it. The first is India has an infrastructure problem, especially in the urban areas. If you visit any large Indian city, you notice it. And it's not fixable because the city, I mean, they've done a pretty good job in terms of highways between cities, but the cities themselves have an infrastructure problem that's not going to go away. That infrastructure problem will get in the way of the India story. The second is they have a legal system that's incredibly slow in terms of delivering on property rights. And if you think about businesses, if you don't have enforcement of property rights in a timely way, it's going to be difficult to grow. And the third is if you have a bureaucracy that is almost incapable of acting because there's no upside to acting. So they delay and they delay. Those seams have been hidden in the last couple of years as people have become excited about the India story, but then they've not gone away. So you're going to see 5 steps forward, 3 steps back. So I wouldn't be surprised if this isn't the first bad surprise you get in India. It's not just a slowing of growth. There will be a crisis somewhere along the way that's built into one of these themes. And you saw that a couple of years ago with the Adani group coming out. So I think you're going to see some. It's unlike the China story where you could take 10 steps forward without those steps back. The nature of India is you're going to get far more going forward and then reversal going forward again. But I think the Indian market is not factoring in enough those seams in pricing in Indian stocks.
Prof, we'll pick up on that discussion just slightly later. Aswath Damodaran, Professor of Finance at NYU Stern School of Business, will be sticking with us. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insights. Now here's a look at Asian chipmakers after the US imposed new restrictions on China's access to vital components for chips and AI. While the latest curbs escalate Washington's efforts to restrain Beijing's tech ambitions, they still stop short of earlier proposals that would have sanctioned more key Chinese firms. China's Ministry of Commerce strongly objects to the new restrictions, calling them unilateral bullying and warning that Beijing will take necessary steps to safeguard its own rights and interests. Well, for more, let's bring in Bryan, DeAngelis, partner and head of the Washington office at Penta Group, a communications firm that comprises former advisors to U.S. presidential candidates. Bryan worked for both Hillary Clinton's and Senator Chris Dodd's 2008 presidential campaigns. Aswath Damodaran, Professor of Finance at NYU Stern School of Business, also with us. Good to have you. We're getting a taste of how it's going to be like under the Trump administration. Headline after headline. How are you reading the latest headlines on China?
Well, what we're reading right now is both Biden's attempt to kind of solidify his legacy on some of these fronts and get ahead of what Trump is planning to do. What's interesting is Trump will, of course, double down and go even further. So there's general consensus in the U.S. that especially with chips and military technology, we need to bring some of that back on shore for the U.S. What'll be exciting and a lot to watch is how far Trump goes with that next year.
Also, what's exciting to watch is China's own reaction.
Yes.
China has said it is better prepared. The question really is, how do you see China responding?
Yeah, I expect them to respond in kind, and what will be different is they had a bit of a partner in Biden, at least in the sense of he's a traditional foreign policy expert and believes in these kind of multilateral relationships. Trump does not. Trump views this as bullying and positions of power and making sure America comes up first.
And that makes China uninvestable, Prof?
Well, not quite with the right price. Everything is investable, so all you have to do is for the price to adjust. I do think, though, that what you're seeing is, for 4 decades, globalization has been the word that's pushed everything. And I think in the last 8 years, both politically and economically, you're starting to see a blowback. You see it in political, in elections. You're also seeing it in economics. So, it's on paper, it's always good to have no tariffs and globalization and best for the and the global economy has benefited, but the benefits have been uneven. And I think what you're seeing here is a political reaction to it. And I'm not sure that the correction is something we want to live with in terms of the pain, but I think it's here.
It's about AI, it's about chips, it is about technology. Would you be a buyer of Chinese chips? They say, or rather tech companies, because valuations are looking pretty good. We have the likes of Michael Burry already buying Chinese chips.
And I think that you look at an Alibaba, you look at a Tencent, you look at Chinese tech companies, they're much more reasonably priced than their US counterparts. So from a pricing perspective, I'm not surprised that there's more buying of Chinese tech companies because the pricing looks attractive relative to the rest of the world. But I think that we have to see how these trade wars actually play out, because there is a lot of money on the table to lose if the wars go, kind of unchecked.
And tariffs, of course, Trump's favorite word, he says in the dictionary. How do you see that being implemented? Already we heard how he intends to impose tariffs on his closest trading partners, the likes of Canada.
This is Trump's #1 priority. We have to take him at his word. This is something he believes right down to his core. So he is going to come in day one. He's going to issue those executive orders. And I think the real challenge for both American businesses and global businesses is, can they work with him on carve-outs and exceptions, using tariffs as a negotiation tool or punitive measure, as opposed to his current approach, which is just blanket tariffs across the board.
And in a way, Bryan, he has already been successful. He had, Trudeau speaking to him about it.
Jumping on a plane and flying to Mar-a-Lago. Yes, he's using this to exert his influence around the world to start his presidency right now. And it's successful. He does, have that ability to really flex his muscles in this respect. And he's going to use that to an extreme. And he's going to use it better than he did his last time around, because he understands the levers of government this time.
How do you see U.S. industries, U.S. companies preparing for that?
They're preparing across the board. They're preparing for really those 2 scenarios. Does he actually go through with blanket tariffs, and how are we going to respond to that? Or can we work with them to figure out some exceptions, particular industries that are going to be impacted? The American people are very pro-tariff, but they don't understand the economic impacts that's going to have, what that's going to do in terms of inflation in our markets. And so there's a big push right now among American businesses to get out there and educate not only Trump and the influences around him, but the people as well.
One of the things expected from Trump is a pushback on climate commitments. How much pressure do you think he'll feel, and how much pressure do you think he'll acknowledge when he comes to power, when it comes to commitments to climate?
To be honest, I think he'll feel zero pressure. I don't think he's found an international agreement he likes. He's not afraid to walk away from them. He's also not afraid to really use them as negotiating tactics with some of the other partners to get what he wants on either the tariff side or the military side or otherwise under his influence. So I don't think he'll have a second thought about pulling out of a lot of climate and other international agreements.
And Prof, when it comes to climate, when it comes to ESG, you're a non-believer anyways.
No, it's not that I don't believe in fighting climate change. I think that's we can talk about that being the existential problem at the moment. I just don't think ESG works. I mean, I've described it as an empty acronym, born in sanctimony, nurtured with hypocrisy, and sold with sophistry. Basically, when you see the way it's been applied and you look at the results you get for all the money that's been spent, you say, why did we do this? What is it exactly we've accomplished after 15 years of ESG? So I think it's just ineffective. It's ineffective, and I think it actually gets in the way of the things we need to do to fight climate change. It's part of a broader argument I have against doing things that look good rather than do good. ESG makes you look good. You do the cosmetic stuff. And with both ESG and sustainability, I think the cosmetic stuff overwhelms the real changes we need to make.
The reality is that you need private sector money to fight the climate crisis. How best then to do that?
Well, I mean, if it's going to be private sector money, it can't be voluntary. You can't leave it up to companies to decide what they will do because, like Gresham's law, bad companies will drive out good companies. It's got to be imposed across the board, which is everybody has to play by the same set of rules. And the problem with ESG is we turned over to corporate CEOs the responsibility that should be with regulators and governments. And that will never end well, because there is going to be that push and pull between, hey, they have a fiduciary responsibility to their shareholders, to their investors. And I don't see how you reconcile that with saying, hey, by the way, why don't you do this stuff on the side that's going to cost your shareholders money? The reason they were able to get away with it was with a false promise, which is you can be good and more valuable. You can be good and make higher returns. That false promise is at the heart of why ESG fell apart.
And Bryan, I mean, what do you see Trump doing in response to the climate agreement? Trump 1.0, we saw the U.S. pulling out of the Paris Agreement. He hates multilateral arrangements.
He does. He does. And I think that will continue. Nothing has changed in that regard. I think he hates ESG. I agree with a lot of those points. I think he's also now supported by a Republican Party that has serious concerns about this and have put a lot of pressure on companies who I think in many ways have been using it more as a slogan and a promotional thing, but they're going to really feel pressure to pull that back even more.
How about other arrangements like TPP, like the Quad arrangement, security arrangements that the U.S. currently has?
The security arrangements will be interesting. We saw what he did last time with NATO, and I think you could see a similar approach where he expects other countries to step up a lot on their own military defense, to perhaps use military contractors from the U.S. to do a lot of that. But generally, I think we've seen what Elon Musk has been talking about with the DOGE committee, the Department of Government Efficiency. They're looking to cut a lot of funding out of the federal government, and I think top of that list will be foreign aid and the money that goes to a lot of these agreements.
And do you expect that to be implemented in the first 100 days, for instance, of the Trump administration?
If not the first 100 days, certainly first year. I mean, it's high up there. I mean, I would say it's tariffs, it's taxes, and then it's slashing the budget.
When it comes to security issues, for instance, we've seen how Trump 1.0 really settled up with the likes of Putin, for instance, and Kim Jong-un. How do you see that shaping his foreign policy for Trump 2.0?
I expect him to pick up where he left off on that front. I don't think he feels bound by traditional, alliances that have governed a lot of the post-World War II era, especially with the U.S. He has talked about ending the Ukraine war on day one. You already see Iran kind of starting to rethink how it's going to approach the U.S. because Trump's in there. That's, can be dangerous on many fronts too, but I think he's going to continue to kind of use, again, that tough guy persona he has, that bullying, to try to pull folks onto his side.
Suffice to say, countries in this part of the world, we're talking about Asian economies, they're pretty on edge.
Yes.
I think the only country that's actually come out to say that, we're not too worried is India because of the relations with between Trump and Modi. How do you think countries in this part of the world should prepare for a Trump 2.0?
I mean, they should expect a trade war with China, and they should expect a lot of pressure to choose a side, which will be very hard.
Did you say choose a side? We don't want to choose a side.
I know you don't want to choose
Singapore?
a side, but Donald Trump wants you to choose sides, and I think he will try to push on that front, and it's going to put a lot of Asian countries in a very difficult spot in terms of foreign policy.
So what might that mean for a region that's resisted taking sides, and what might that mean for organizations like ASEAN?
It could mean, you know, an extension of some of the tariff stuff he's talking about. It could mean some of the trade partnerships that have, you mentioned TPP, that have been on the table for the past, you know, several years. It could mean some of the security deals that are in place as well. I mean, what is different about Trump this time is he understands all those levers of government this time, and he's surrounding himself with people that believe what he believes, and they're going to use that to their full extent to get what he wants.
Of course, when you talk about potential flashpoints in Asia, that would be the Taiwan Strait.
Yes.
That would be the South China Sea. Might Trump adopt the kind of attitude that he's adopting in the Middle East, where, you know, he says he can put a stop to it in 24 hours?
Yes, I think he thinks of himself as a deal maker, as someone that can solve
Even
these
for
problems.
Taiwan and South China Sea?
Perhaps. That would be a tough one, obviously, to take on, but I have yet to see a challenge that Donald Trump doesn't think he can be successful on. So he could very much try that. I think he's probably has a lot of people around him that are telling him to hold off on that while he figures out Ukraine and some of the other issues he's talked about.
Professor, as much as you say that, you know, you're not a politics expert, but, you know, taking politics into consideration, and when you take a look at valuations, for instance, in this part of the world, you like India because of the potential. Is there any other market that looks attractive?
I mean, if you think China is going to be targeted, markets like Vietnam will be beneficiaries because you got to move stuff somewhere. You can't, I mean, much of the stuff can't be moved back to the U.S. We really, I mean, it's not economically viable.
So the China plus one.
So in a strange way, companies that keep their head down might benefit from a U.S.-China war, might be the markets you want to go into. Now, but staying on Trump, I think what I see is a real estate deal maker, kind of doing what he used to do in real estate in the international arena. The only problem is, in real estate, if a deal falls apart, a building doesn't get built. Here, if a deal falls apart, you could have a nuclear war. So there is this very real threat that he might take the deal making a little too far, use threats without understanding what the consequences will be. That is what you have to worry about over the next 4 years, is will the deal making get to a point where it creates some real consequences with, you know, that spread across the world. So we'll see how far he pushes it, because right now I think he feels on top of the world. He feels he can push the deal making as far as, but I think the one thing I would add to the mix of things, the tariff, is immigration. To him, immigration is the other item. In many ways, his tariffs are, he's willing to negotiate on the tariffs if you will close the border. So with both Canada and Mexico, that seems to be the quid pro quo that he's looking for, is you close the borders down, the tariffs go away. So immigration, I think, is going to be a central issue that drives everything he does internationally. And to the extent that that becomes the central issue, you know, you got to go back to it and say that drives how his decision making.
And Bryan, what do you think is the biggest risk for the world under Trump 2.0?
I think it is a global trade war. I think it's, you know, really not understanding the effects of, if we start to pick at globalization, as the professor said earlier, what that's going to really mean for some economies. And, you know, I also agree with that last point. How far does Trump push on some of this deal making? And does he have the team of experts around him that are going to say no, that are going to tell him when to stop, and is he going to listen to them?
And of course, we'll know soon enough. Bryan, thank you so much for dropping by. Bryan DeAngelis, partner and head of Washington office of Penta Group. Aswath Damodaran of NYU Stern School of Business is sticking around. Plenty more ahead. Keep it here with us. This is Bloomberg. Well, it has been trading for about 3 minutes now, and it is in positive territory in line with the rest of the Asian benchmark. Sensex up about 0.1%. We have the Nifty Bank also in positive territory, higher by 0.6%. In terms of the rupee, 84.74, pretty flat versus the USD. We're also checking on Adani stocks, Adani green stocks in particular, recovering fully from the losses that we saw after the U.S. indictment. Adani Enterprises up 0.8%. Adani Green surging ahead, adding by about 1.2%. Now let's get insights on India and those stocks we've been talking about. Professor Aswath Damodaran is still with us. Adani going strong. Is it surprising? I mean, it's recovered all the losses in just 7 sessions.
When Hindenburg first targeted Adani and essentially pointed to the things it did, my reaction was, you think Adani is the only group that does stuff like this? Because in a sense, they might have exploited the seams we talked about in the Indian economy the most, but they were taking advantage of the slowness of the bureaucracy, the fact that the rules didn't get enforced quickly. I think the indictment was a surprise in the sense that markets said, we didn't expect that. And my guess is if it had been anybody but Gautam Adani, you wouldn't have a US Justice Department indictment of a CEO for something that is happening in India, but they're based on the fact that you were raising cap. That's unusual. So I have a feeling that there was a political component to that indictment, even though they will never admit to it. So I think markets...
But the recovery of Adani Green stocks...
And that's precisely why. If it's a political component, it becomes more of the same. Because in the last 2 years, I mean, the Adani Group has always been at the center of political debate, because it's one of the few family groups in India. Family groups in India have always had political connections, but with both sides of the divide, because they have to live with... The Adani Group threw all of their chips on one side of the divide. That side of the divide has happened to win elections in India, and they've benefited. So it is unusual as a family group because it is a family group that's so closely tied to one side of the political divide.
Of course, it is an infrastructure play, and hence the interest from a lot of investors. Would you be a buyer? Would you wait for the dust to settle, or has the dust settled already?
I'll be quite honest. I don't like to buy family group companies precisely because I feel so little in control of my own destiny, because so much of what they do can transfer wealth across companies, and I can't stop it from happening. It's not specific to Adani. I don't own shares in the Reliance Group. I don't own shares in the Tata Group, because when you're investing in a family group company, technically it's an independent company, but it's part of a family group. There are intra-company transactions that can happen. So I wouldn't be a buyer, but that doesn't mean that if you want to invest in Indian stocks, you shouldn't be a buyer. I'm glad you mentioned the infrastructure part, because if you buy into the India story, the infrastructure component obviously is one of the big ways you make money. And Adani, in spite of all the criticism of what it does, is a pretty good infrastructure player. I mean, we landed in Mumbai Airport, which is an Adani, infrastructure investment. It is well constructed, it's well done, which is not the same thing you'd say about a lot of Indian infrastructure investment. They're a competent company. And it'll be interesting to see how the political connections play out.
The same can be said of the Reliance Group. I mean, it is a telecom play. It is an infrastructure play as well. So what's the concern when it comes to Reliance?
Reliance, I think what's different is they've used their petrochemical business, which is a cash cow, to create Reliance Jio. And I've often said every Indian tech company should be required to pay Reliance about 20% of its market cap, because what Reliance has done is made the smartphone something that every Indian can have. By providing internet service and providing smartphones at low cost, they've allowed companies that build off technology to be able to grow. No other company could have done what Reliance did, because you needed to trust the company to do the right thing, because they were taking money in hundreds of millions of dollars and putting it into Reliance. Trust us, we know what we're doing. And because people trusted Mukesh Ambani to do the right thing, He got the slack to be able to do it. So I think that as a group, Reliance has been able to do that cross-company subsidization because people trust Mukesh Ambani to make the right judgments.
Prof, we have to talk about other tech companies in India as well, the likes of Paytm, and of course, Zomato has been in the news as well. How are you looking at all these companies?
I think the good news is India is seeing young tech companies go public. The old Indian tech companies were outsourcing companies. They were really not tech companies. They did the back office for US companies. And what you're getting in this last decade are Indian tech companies trying to do what Silicon Valley tech companies do, provide intermediation services, charge for it. My one concern, though, is there's a lot of buzz around these IPOs. They draw on traders who think they can double their money, quadruple their money. It goes back to a point I make about investing. Investing shouldn't be about trying to get rich. It should be about preserving and growing wealth. But that's not why people are investing. They want to double their wealth. They want to triple their wealth. So it's a lot of greed driving the pricing. And my concern is that'll mean the pricing can disconnect from the fundamentals, and you wake up one day and say, how the heck do you explain what we're paying? More so for Zomato. Paytm went in the other direction, which is, at this point, people are not convinced that the company can convert its huge user base into money. Because you're competing against UPI, which allows you to transfer money for free. So in India, any kind of money intermediation service is going to have much lower take rates than in the rest of the world. And people are coming to terms with that.
All right, Prof. Great having you with us for the past hour. Thank you for joining us on Insights.
Thank you for having me.
Aswath Damodaran, Professor of Finance at NYU Stern School of Business. Before we go, let's take a look at how Asian benchmarks are doing. They are mostly in positive territory, tracking the gains we saw overnight on Wall Street. Of course, we had the S&P clocking its 54th record high. MSCI currently up by about 1%. The benchmark in Japan also in positive territory. The Nikkei 225 up by more than 2%. In terms of Asian FX, it is a strong dollar story. The yen trading 150.12, down about 0.3% versus the USD. And before we go, here's a look at our guests for tomorrow. We'll get insights on the future of trade relations in Asia with former South Korean Trade Minister Johan Koo, plus an interview with the COO of Vietnam's logistics and industrial real estate platform, BW Industrial. Plus, we'll discuss efforts to level up the gaming industry with an NYU professor. This is Bloomberg.